topics and opinions expressed in the following show are solely those of the hosts and their guests and not those of W4CY Radio, its employees, or affiliates. We make no recommendations or endorsements for radio show programs, services, or products mentioned on air or on our web. No liability, explicit or implied, shall be extended to W4CY Radio or its employees or affiliates. Any questions or comments should be directed to those show hosts. Thank you for choosing W4CY Radio.
Barry G. Fowler, EA, brings you Tax Talk for You right here on W4CY Radio and Talk4 TV. As an enrolled agent and a national leader in tax resolution, as well as trucker, bookkeeping, and tax planning with over 30 years of experience, Barry will break down taxes, bookkeeping, tax planning, and tax relief for individuals and businesses just like you. So let's have some Tax Talk for You with your host, Barry G. Fowler.
Hey, welcome. It's another great Monday, leading into a great week. God bless you to be here and to be up now, do something important and exciting and fun for the family this week. Hey, this week we honor veterans, and tomorrow is Veterans Day. Day that honors all that have served in the United States Armed Forces in times of war and in times of peace. It's actually the day. If you don't do it any other day of the year, it's the day to thank all veterans for their service. Acknowledge the sacrifices they have made, their families have made, and the contributions they've made to this great country. And then also show appreciation for the courage and dedication. I mean, this country would not be the country it is without our veterans. And, that day, Veterans Day, tomorrow is the day to honor them above all. We recognize all veterans. It's dedicated to everyone who has served in the United States military, but not just those that fought in some specific war. If you've served, thank you. Thank you for your service to this country. We could not have the freedoms we have today without our great military and armed forces. Well, that being said, let's talk about taxes. Now that we get the privilege of living in this great country, we got to have the privilege of paying taxes, right? Oh my Lanta, we got to do some planning. And today, what we're going to be talking about above all for people is tax strategies as a business owner. You own your business. Now, it doesn't matter to me, whether you're reporting on Schedule C as a business owner, you're reporting as an S Corp on 1120S, you're reporting as a partnership on a 1065. You've got to have strategies. You've got to have ways to reduce the taxes that you are going to pay for your family. Now, if you're reporting on one of those three forms, you are getting taxed at the bottom line on your personal tax return. So net income. Schedule C, bottom line of your net income right there is tax for Social Security and Medicare and federal income taxes after a few adjustments. 1120 and 1065, you're both going to get K1s from those entities. So being taxed as an S Corp, you get a pass through and you get taxed for federal income tax on there and reasonable wages as a W-2. And then 1065, you're going to get guaranteed payments and net income from the business and be taxed there. Now, if you are a corporation taxed as a C Corp and you didn't make the election for S Corp, then the corporation pays the corporate tax. If you get distributions, you get 1099 dividends because they don't have distributions, it's dividends. And then you also have W-2 wages. Now, where does tax planning begin? Well, tax planning should have begun early on in the beginning of the year. Tax planning should have begun with starting bookkeeping, taking an account of all transactions that happen for your business. Now, I tell you, if you are in business, make sure you have a separate bank account just for the business. Don't run anything personal through it. Matter of fact, you take your distributions or you take your wages and those go to your personal account, and then you pay all your personal expenses out of your personal account, not out of the business account. No commingling. Now you've got good bookkeeping, meaning you've got not just an income statement or cash flow statement, but you've actually got a balance sheet and an income statement. Start looking there, doing a comparison, and hopefully you had good bookkeeping last year, or if you're new in business, this is a great practice to go through and start analyzing what's happening in your business. Look at your profit and loss. Does it have all your expenses that you expected to be there? Even the little things. If you have a telephone or cell phone service through the business, is it recorded there? Are you getting all your office supplies and everything else recorded there? Maybe you're buying things out of your personal account because you had expenses that you didn't have a credit card or something. Did you account for all those expenses? So every expense matters. So when we talk about strategies, we want to make sure you're capturing every expense possible. Look at your balance sheet. Now, your balance sheet, yes, is going to have what's in your bank account, reconciled amount. It's going to have maybe your accounts receivable, who owes you money, accounts payable, who you owe money to. Your loans, you may have loans that are outstanding that you owe people, or maybe somebody owes you money. You're going to have assets. You bought equipment, property, land, building this year. That should be accounted for on the balance sheet as a fixed asset. And if you're running a comparison from one year to the next, you'll be able to see the changes and the differences right there on the balance sheet. Now, when you start seeing those things, we're going to be able to explain more how this is going to benefit you as a business owner, looking at how to save money on taxes. Because realistically, your tax strategy is to get you into a better tax bracket, lower the tax rates down, find strategies to keep the taxes to the lowest amount allowed by law. So why do we do these strategies? I mean, who really wants to pay 37% income tax plus maybe another 3.8% in net investment tax? Nobody really wants to do it. I don't care how much money you make. People don't want to give money to the federal government. Or if you're in a state that's charging you, you don't want to give money to the state either. I mean, we all see that neither the federal or state governments know how to spend money. Actually, they know how to spend money. They waste money, but they don't know how to be reasonable. They don't know how to have a good budget. They don't know how to break even in their revenues. They just rather just spend haphazardly than, save money. Hey, talking about saving money and tax rates, I got into a disagreement with one of our county commissioners. They were promoting an extra 1% sales tax in our area because in the area that I live in, it's not in a city, so it's unincorporated area. We pay a lower sales tax rate than other people do. Our county commissioner decided he wanted to be able to add this 1% in, and he was supporting it. And he says, well, it's not really a tax increase. You're already getting charged. No, I wasn't getting charged. I don't want to pay an extra 1% in tax. Nobody wants to pay more in tax. Yes, this went down in defeat. It said right there on the ballot that it was a tax increase, but he said it wasn't. It is. So, little fun things like that. Nobody wants to pay more in tax. If you had the opportunity to lower your tax rate, you would, wouldn't you? I'd be the first one to raise my hand and say, yes, I want a lower tax rate. I am not going to raise my hand and say, increase my taxes just because I want to pay more. We want to find ways all the time to pay less money in taxes. So again, we started looking at your income statement, your profit and loss, your balance sheet, and making sure that you have every deduction for your business that's allowed by law. Is it ordinary necessary business expenses? Are they classifying the money that you are paying for marketing in marketing? So maybe you're contributing and doing something at the church and it's advertising. You're putting banners up. You're doing other things to get your name out. Well, it does more for you as a marketing expense than it does as a charitable contribution. Yes, it feels nice as a charitable contribution, but the tax deduction is better if it is a marketing expense. So if you got some marketing out of it, you can classify it as marketing expense versus charitable contributions. Now, we've got to look at all the different ideas here on tax planning strategies for your business. So whether you're an owner operator, whether you're in retail, whether you're in marketing and consulting, whatever, you've got to do planning for your business. We're going to take a quick break, and when we come back from this break, we're going to continue talking about tax planning for your business. We'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. If you owe the IRS or are going through an IRS audit, don't go at it alone. Call Taxation Solutions Tax Relief at 888-930-1016. We are your solution for IRS debts, audits, back taxes, garnishments, liens, and levies. Whether you're an individual or business, you need a solution and a strong, aggressive tax resolution. Don't let the IRS walk all over you. Stop the IRS now. Call 888-930-1016 or go to taxationsolutions.net now for a free, no obligation consultation. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, I promised one of my friends who reached out on me, and he says, I heard you thanking veterans for Veterans Day and everything. Can you mention me out there? I said, man, everybody's got to have their 15 minutes of fame. So everybody needs to hear, Michael, I appreciate your service, for this country and your friends that served with you as well. Thank you for your service. And, hope you continue listening to us and everything out there. It's a day of being thankful and seeing, if you see a veteran out there, you see somebody that has served or even somebody currently in the military, hey, thank them for their service out there. Hey, we're talking about business planning and tax planning strategies for 2025 for this year. We'll get into some 2026 stuff that you can do while you're working on 2025's planning. I mean, we've only got, less than 2 months left in this year. Can you believe how fast this year has gone by again? Man, so implementing strategies now, maybe you didn't think about it earlier in the year. You got to think about it now. So, some of the key strategies we're going to be talking about is taking advantage of bonus depreciation for asset purchases, maximizing the qualified business income deduction, QBI, utilizing business interest expense deductions, and other effective tactics that we're going to come through and talk about as well. Such things as timing of income and expenses, and then optimizing maybe your business structure for 2026, maximizing retirement contributions. But we're going to get into that, all a little bit more in depth as we go through. So some of the key strategies again for 2025 right now. The One Big Beautiful Bill Act of 2025 permanently reinstated 100% bonus depreciation for qualifying property placed in service after January 19, 2025. This means your business can fully expense the cost of eligible equipment in the year purchased. So if you purchase something after January 19, 2025, you're going to be able to use Section 179 to fully depreciate your equipment. Now, watch out for this because, depending on how much equipment you bought, if you're going to be fully expensing things at 179, you don't want to take the tax rate down to where you're not paying quite anything, because now you might be wasting depreciation, because the next year you might be back up into the much higher tax bracket. So you kind of got to weigh how much depreciation you're going to use based on your net income and based on your tax situation. So we're always looking at that. But the maximum deduction limit for Section 179 expensing increased to $2.5 million for property placed in service after December 31, 24, with a phase out threshold at $4 million. Qualified production property business can also take 100% bonus depreciation for this qualified production property placed in service before January 1, 2031, if construction began after January 19, 2025. So there's little tweaks in the dates out there. So you kind of got to watch and look at the actual rules behind everything of when property was placed in service, and when maybe you started construction as well, like unqualified production property. Now, the other good thing that happened in the One Big Beautiful Bill that helps you with your tax strategies for this year is the Qualified Business Income Deduction, QBI. Now, if you've been in business, you're probably heard about the 20% QBI deduction, the Section 199A. The One Big Beautiful Bill made it permanent, and that's eligible for pass-through entities. So this deduction was expanded and set a minimum deduction of $400, and as long as you had at least $1,000 of qualified business income, QBI. Yeah, a little bit complicated calculation out here that you've got to go through, and if you have losses, it complicates things further. Carrying losses forward from QBI complicates things. Make sure you're working with your tax preparer to know how this QBI deduction is going to work and how it's going to work to your advantage, or how it could affect you in the future, also going forward due to the losses and everything as it carries forward. QBI has always been one of these nice things when you're making money, but complicated things when you've been losing money for a few years and you're carrying the QBI losses forward. Also has other complicated factors in there with wages and property and equipment and stuff like that. So it's not something that I recommend anybody tread lightly through. Make sure you got a qualified tax preparer, enrolled agent like us here at Taxation Solutions Trucker Tax Tools, and that you've got the right calculations in there for the QBI. Now, I know, tax software, hey, don't worry about it. Everything's going to be easy. it's still one of those things that unless you're carrying it forward from year to year in that same software, and unless they carry it forward for you, most people don't realize it and just ignore. And then they get audited for this QBI problem, and you've got to go back in and fix it. Trust me, the IRS is tracking in some way, shape, or form, and they will figure this out. Hey, speaking of deductions and QBI and even truckers, owner-operators out there and small businesses, truckertaxtools.com is the site that you can go to. We help truckers with bookkeeping and taxes. Trucker Tax Tools is geared strictly around you as a trucker to make your life run smoother, help you with bookkeeping, make sure that you have tax planning that you need, make sure that you know how much your estimated tax payment should be made during the year so that you're not hit with a huge tax bill come April 15th, and then penalties for not making your estimated tax payments as well. So contact us at Trucker Tax Tools and go to truckertaxtools.com, hit our info page there, and you'll be able to connect with us on that site so that you are getting every deduction possible. That phone number is 877-966-2477. Again, 877-966-2477. So get in touch with us there. Let us help you with your bookkeeping and your taxes. As we're talking about, business tax planning and everything else, something you can look at as a business owner potentially is timing your income and your expenses. So if you're using a cash basis accounting, accelerating your expenses into the current year would help you bring down your net income. So if there are expenses that you can pay and you utilize this year, it's something you can look at paying those as well. If you are on an accrual basis, again, you can be buying things and having payables, and you maybe slow down your collections and your receivables. Same thing goes on a cash basis. You can slow down collections and less money that you receive in during the last month of the year. It defers it possibly to collections in January, which takes the income into the next year because you are cash basis. So it's timing. So if you're receiving less cash in today and receiving it in January, then you would be bringing down the gross revenue, which in turn would reduce your net income, which in turn then lowers your taxes. Now, the next year's tax rate is going to be a little bit higher, but you deferred it out a whole another year that you would have to pay the federal income tax or state income tax on that money. And if you're a Schedule C filer, you've also deferred paying Social Security and Medicare out a whole other year as well. Now, brings us to a lot of other fun things we can do in for the business. And we're going to talk about some more great opportunities for tax planning for your business, either as a owner-operator, consultant, retail business, you name it, you need strategies. And we've got a few more great strategies coming up right after this break.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Trucker Tax Tools handles all your bookkeeping and taxes no matter what level trucker you are. Life on the road can be taxing, but that doesn't mean that your wallet or time with your family should suffer. Trucker Tax Tools makes your life run smoothly. Go to truckertaxtools.com for a free guide that will give you the tools to never worry about your taxes again. Call Trucker Tax Tools 877-966-2477 or go to truckertaxtools.com now and let the experts keep you trucking. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. We're talking about tax strategies, saving money on taxes. And I mean, that becomes a real big key to most business owners. You want to find a way to save money on taxes. I mean, what happens when you get hit with that huge tax bill at the end of the year? You go into a panic. You don't know where the money's coming from. Maybe you've been in business for a number of years and you've had great years and you haven't been able to afford to pay the taxes and you got tax debt. Well, that's where Taxation Solutions comes in. Saves you from the IRS, saves you from having to pay the IRS all at once. Maybe you need an installment agreement. Maybe you can qualify for an offer in compromise because your income is way down this year. Whatever the case is, we're in a no judgment zone at Taxation Solutions. Taxation Solutions Tax Relief is going to be your representation for strong, aggressive tax resolution against the IRS. So don't let them walk all over you. Give us a call at 888-930-1016. Again, 888-930-1016. Or just go to taxationsolutions.net. Again, taxationsolutions.net. Get a free consultation, no obligation. Hey, sometimes we're not going to take you as a client. We're going to tell you what to do, how you can help yourself, and solve the problem, without having to pay somebody to do it because it may not be worth hiring somebody to do. Well, we're getting back to talking about tax strategies. So what else can you do as a business owner? Well, one of the things you can do as a business owner is employ family members. Hey, maybe you've got kids, even kids in college, kids in high school. If they are able to work in your business, you can hire family members to work for you. Most likely, they're going to be in a lower tax bracket. So, I have a daughter in college who does a lot of stuff for us via social media. She does some other administrative work for us as well. We can pay her for the hours and the time that she spends and works, and she can use that money to pay for her college. So we get the deduction on our books and lowers our taxes down. She's W-2. Yes, we've got to pay Social Security and Medicare on it, and she has to pay federal withholdings and stuff on it. But she's in a lower tax bracket. She's going to be in a 10% tax bracket. So if your business income and your family livelihood is going to drive you up to, a 25% or 37% tax bracket, hiring these family members definitely decreases that tax rate. And they're working in the business. You can't just pay them to do nothing. They actually have to be an employee. They actually have to work. Now, you might even be able to hire them contract, but again, they're going to pay Social Security and Medicare on that money. If it's Schedule C, maybe you can set them up in their own S Corp and then pay them, and then they got to file taxes and everything from there. So employing family members, even younger kids that can actually work in the business for you, they can use that money to buy clothes, pay for sports. Maybe they're playing travel ball, travel cheer, travel swim, any number of sports that have, travel as well and have other expenses. You're playing select, things like that. They can use that money to pay for all of those things as well. And it doesn't come out of your budget, it becomes out of their funds. You can even set them up for retirement accounts. And now you've done something that most people haven't done, is you've set them up for life if they never touch that and let that continue to grow. Now, speaking of retirement accounts, use those to lower your income for you and your business. Now, you can maximize your retirement contributions. So even if you're just doing your simple IRAs, you can reduce your taxable income while building retirement savings. And then those limits have increased for 2025. Now, if you have a plan through the business, so maybe a solo 401k or maybe a 401k for the business or a simple SEP IRA, those plans have higher limits and you can maximize your contributions. If you have employees, then you've got to work out matches. So, you could have a 1 or 2% match for employees and yourself, but it does lower the amount that you can actually contribute into these 401k plans, because whatever you match for yourself, you got to use the same percentage to match for them. You might even be able to use a defined benefit plan. Now, I think most of these things come into really good play when you have strong net income and you want to build loyalty of the employees with you. You can have the 401k with matching plans and with stipulations in there of how long the vesting period is as well. So it's not something you're just giving away money and they're going to turn around and walk in, a year or 2 or 3. So you can also put stipulations when that matching kicks in, things like that. I suggest you talk to your benefits coordinator and have them work with you to see how is this going to help and assist you in providing the best benefits for you, your family, your company, and what kind of contributions you're going to have, and is it worth it? Now, you get some deductions for other taxes and things like that, so keep those things in mind, and the tax credits might even be worth it out there as well. Now, a couple things that I want to start touching on. So we've gone through all this planning for 2025. So you have an idea of what's going on. Your tax preparer should be sitting there with their software and saying, hey, this is the estimated taxes you're going to have for 2025. We're doing that for our clients. We're starting that process right now of in-depth tax planning for our clients. So if you're a trucker and you're not with Trucker Tax Tools, talk to your tax people, your bookkeeping people. How are they doing a tax plan for you? We're doing those tax plans here currently and starting to work with our clients on planning. In the first couple of years, we were in this and we were really getting into tax planning. And a lot of our truckers were like, hey, I've never had anybody do this before. This is new. This is different. Now they come to expect it. But hey, you have great ideas. Nobody's ever told me to plan for retirement. My retirement was sitting in this truck, driving till I dropped, until they buried me in this truck. Well, what about family? What about being able to retire and enjoy life? I've seen way too many truckers that are in their 70s still driving because they've never done planning. They've never planned for retirement, never planned to be out of the truck. Well, maybe it's time. As a business owner, you should always be planning. So you've started this, you started your planning, you're starting to look at what your net income is. If you're a Schedule C, maybe it's time to consider a new structure. So should you be an S corp. Maybe you're an LLC and you now could possibly be a multi-member LLC and file as a partnership. Will these strategies work? Will they save you money? So the first thing we look at is, should you be an S corp? Should you be a multi-member LLC? Now, the difference is between those two is maybe as a husband and wife, we can make you a multi-member LLC and file as a partnership. You can elect that. Maybe you don't want to, you're not married, don't have a spouse, and you don't want to take on a partner, might be an S corp. Are these strategies right for everybody? No, they're not. You know, I hear all the time, hey, so-and-so said I should be an S corp. So-and-so said I should be a multi-member partnership and file a partnership return. Well, partnership returns are a little bit easier. It keeps the trash off the personal return, which I'm all for. It lets you modify what your wages are going to be by using a guaranteed payment. But you do have to file that extra tax return. So it does add a level of complications to your life and expense for that. If you're not saving enough money, and it's going to be no different filing a partnership return than it is filing a Schedule C, then why do it? Other than getting the trash and the audit ease over to a partnership return, that's life choices. So now, what about an S corp? Everybody wants to know, don't you? And guess what? I'm going to fill you in because we're going to take a quick break. And then after we come back, we're going to talk about S corps, why you should or why you shouldn't be an S corp. We'll do that right after this.
We have only scratched the surface of today's show. Please stand by as Barry G. Fowler will be right back with Tax Talk for You. As an owner-operator, you already spend too much time away from your family. Stop spending time doing paperwork. Go to truckertaxtools.com, a solution built specifically for truckers. Truckertaxtools.com makes your life run smoothly. Let's get back to Tax Talk for You with more Tax Talk. Once again, here's your host, Barry G. Fowler.
Hey, welcome back. Should you be an S corp or shouldn't you? Hey, that's one of the big questions when you're in business. Now, we go through a complete calculation on this, and we show where this money can save you money, where it can save you in taxes, and what the drawbacks are. So there's some good things, there's some bad things. It really depends on your perspective. So first off, we're going to look at net income. Where's your net income? If your net income is, $40,000, $50,000, being an S corp isn't necessarily 100% advisable. Unless you want to get the trash off a personal return onto a business return, you can do that. But being an S corp means you got to pay a reasonable wage to the business owner that works in the business. Meaning, if you were working in the business, for what you do for the business, you would have to receive a reasonable wage for that work. That means W-2 income, added level of complexity. If there's not enough savings, why spend the money for payroll and a payroll service? Not to mention the tax return to be done, to not have any benefit in your pocket. Now, income becomes $100,000, $150,000, $200,000 is your net income. Now we're talking about potential savings. That savings is going to be the difference between the max taxable amount for Social Security. So that would be right around $186,000 and what a reasonable wage can be. So if your business was netting $200,000, let's say, you're going to pay Social Security and Medicare tax as a Schedule C on the full $186,000, plus Medicare goes all the way up to the $200,000. However, if your reasonable wage for what you do for the business was only that $86,000, you now don't pay Social Security and Medicare tax on that other $100,000. So that saves you $15,300 a year in Social Security and Medicare. Plus, there's that other 2% that you're going to pay from the 186 to the 200,000. So added a little bit more to it than there. And now that becomes a lot more worthwhile of doing. Or if your net income is 100,000 and reasonable wage for what you do is 50,000, you're going to save right around $7,500. That's $7,500 in your pocket, not in the government. Now, what's the drawback? You're paying less into Social Security and Medicare. However, let's roll back to the retirement accounts. If you take that savings and you were to make sure you contributed it into your retirement account, and you made your normal contribution that you would have made into your IRA, you've now got a whole bunch more money into retirement. So if you're able to set up a solo 401k for your business, we rolled all that money into the solo 401k, means you're going to have about $15,300 in your solo 401k that if you don't touch is going to continue to grow until retirement age, and then you can draw. And if you do this every single year and you never touch it and it continues to compound every year, you could retire as a millionaire. If you started this very young and contributed every year, man, when you get to retirement age, it is going to be a beautiful retirement for you. It's what we try to teach our kids. We try to teach our family. Hey, something else you can start considering doing. If you're running a really good business, and maybe it's a business that, maybe your family members eventually want to get into, or maybe they will get into one day, they need to get out and work for somebody else and then come to work for you eventually. Maybe gifting a percentage of your business to them. So, if your business goes through up and down cycles, when you're in a down cycle and you gift shares of your business, and especially a business that may be worth much more than what the inheritance tax level is going to be, then you want to find ways to move money out of your pocket into somebody else's pocket, and especially your beneficiaries, because they'd be paying tax on it. And this is one way of moving the shares from one to the other. Now, if it's set up as like a partnership, this can be really easy and really nice because it can be shares of capital, but not participating in profit and loss of the business. So if you ever sold the business, they would have the percentage of capital. So you can have different levels of shares in a partnership, or even an LLC, whereas in S Corp, you've got to have one class of stock, and then therefore they would receive distributions just like you would of profits if you're distributing profits, and they would be responsible for the tax on it. So we use this in like a real estate investment holding company. The building's sitting in here and it's receiving rents and paying taxes and everything. And heirs have a different class of stock. So maybe they own 5% of the capital in the business each, and the mother and father own, if there were 3 kids, that's 15%, and mother and father own the other 85%, and those are voting shares and capital. But on the profit side or the loss side, those shares, Class A, let's say, would receive 100% of the profit from the rental properties and everything directly via K1. The kids won't receive anything unless the company is actually sold or liquidated. So it's kind of a beautiful way to carry property, they have only ownership in the shares of the stock or the membership interest, but they're in a different class, meaning they have no voting rights, they have no access to anything through the company, and they just own shares of capital. And mom and dad basically own the operating shares, operate the company, and receive the profits from the business, or the losses from the business goes to them, not to the kids. So it's kind of a beautiful way. And eventually, if the parents pass away, those shares, the rest of the capital then would be distributed, and the operating shares would be distributed to the kids if so see fit, or if the company is liquidated upon death, then they would receive the capital that came out from the business. So it kind of gives you ways of moving the interest from you here to the children without impacting their taxes. Maybe you wanted to impact their taxes and have the money go over to them and part of the profit. You can just set it up that way as well. It's one of the fun things you can do in your business to make things work for you and your family. I had a quick question about charitable contributions. Ray, hey, I really appreciate the question. Charitable contributions. Yes, the one big, beautiful bill had a provision in it that could influence the timing of your gifts or charitable contributions. Starting in 2026, corporations may only deduct gifts in excess of 1% of their taxable income. Now, this is corporations 1120s. Doesn't have anything to do with 1120Ss or 1065s. Those charitable contributions pass through to you on your personal tax return. And yes, you get some benefit of charitable contributions. Depending on how much the charitable contributions are, will depend on the magnitude of the effect it has. Now, you're going to have some direct limited deductions there, not on Schedule A, but excess above that limitation starting in 2026 is all going to still go on Schedule A if you're above that threshold that they have for you on the taxes. I still say if you're in business, everything you do, whether you're making a charitable contribution, you're participating maybe in a charity golf event, maybe you're participating at your church's bazaar and you're sponsoring things. It's not necessarily a charitable contribution. That is advertising, that is marketing. You're getting your name out there. Don't classify it as a charitable contribution. Classify it as marketing expenses. Now, if you're just giving a gift to the church on a Sunday, and you're just giving it and there's no benefit of marketing out of it, it's not a marketing expense. It's charitable contribution. Don't try to classify it any other way. So those are the things that you need to keep in mind. Hey, what do we take out of all this today? Planning, planning, planning. The more planning you do, the less you hopefully will pay in taxes. Find a good tax preparer. Find somebody that's an enrolled agent that'll sit down and work with you. That, whether it's virtual, whether it's in office, whether it's remote, you got to have somebody to talk to do planning. We're doing planning now for our truckers. Taxation Solutions does planning for their clients as well. Find somebody good, find somebody that knows your industry, and above all, plan, 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 plan. And they say in real estate, it's location, location, location. In taxes, I say all year long, it's planning, planning, planning. Get your tax plan in. Make sure your tax plan is right. Review your tax plan. Planning, planning, planning. Hey, this is a great week, great day. We're coming to, 6 weeks left in the year. Get your plans done. Tomorrow, celebrate. Thank a veteran. To all our veterans out there, thank you, thank you, thank you for all you've done for this country. God bless you. Hey, tune in here every Monday at 10 a.m. Eastern Time on Tax Talk for You. Again, that's Tax Talk, 4, letter U.com. Follow us over there and never miss an episode whatsoever. And we'll be right here on W4CY Radio, 10 a.m. Mondays, Eastern Time. Be here, tune in. Let us answer your questions. We'll see you next week. Have a God-blessed, glorious week. And again, thank you, veterans.
Are you an individual or business that wants to understand taxes and how they affect you? Are you looking for specific tax advice for self-employed, business owners, and truckers? Are you behind on taxes and your bookkeeping? Are you dealing with the IRS and ready to have some relief? Then you need Tax Talk for You, hosted by tax and trucker expert Barry G. Fowler, EA. Tune in 10 a.m. Eastern Time every Monday right here on W4CY Radio and Talk4 TV. Don't forget to check this and past episodes at TaxTalkForYou.com. See you next week at W4CY.com.